Welcome to the Three Edge Week in Review for the week of September 25th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today is Dr. Bob Phillips, the Chief Technology Officer and member of the Investment Committee here at Three Edge Asset Management. And this week, Bob and I will discuss two of the key drivers of inflation: energy, with a focus on oil prices, and labor, with a focus on wages. And neither of those are currently helping the Fed in their effort to bring down inflation as soon as originally hoped for on Wall Street. Before we get to today's topic, though, a brief recap of this week's activity in the markets. And really following the most recent FOMC meeting, investors seem to finally coming around to the notion that the Fed may need to keep interest rates higher for longer. And interestingly, this seemed to surprise folks on Wall Street. However, this news should not come as a surprise to our listeners, since here at Three Edge, we've always thought that the fight against inflation wouldn't be so easy, and we've not been adherents to the idea of immaculate disinflation, whereby inflation comes down to the Fed's 2% target quickly and without economic pain. So, at least for now, the mood on Wall Street has seemed to shift. Bond yields have continued to rise to levels not seen in decades. Meanwhile, interest rates on 30-year mortgages recently surpassed the 7% mark. So it's a very different world. So Bob, first, thanks for joining the Three Edge Week in Review, and let's get into it. And I know that you are just back from California and the Code Technology Conference, which always seems to have big names in technology and business. The CEO of X, formerly Twitter, Linda Yaccarino, Chief Technology Officer at Microsoft, Kevin Scott. And then you and I talked earlier this week that there was a great deal of attention, paid to generative AI, electric vehicles, and that makes sense. Those are two big topics for investors. But what was interesting to me is that you indicated that there was a good deal of discussion around inflation and the potential impact of rising labor costs and the price of energy. And I suppose that makes sense, right? Because maybe those two technologies will produce greater productivity and ease the pain from inflation. But I think we probably both agree not soon enough for what we're up against here. So, but why don't we just, kick this off and have you talk about these two key drivers: energy, oil prices, labor, and wages. And what could this mean if we have rates that are higher for longer for the economy and the markets?
Well, thanks, Fritz. Yes, those are very interesting topics. And as you mentioned, it was interesting at this conference that, well, a lot of the talks on stage were about technology, as you'd expect. And in many cases, when you hear technologists speak, they're always very optimistic about the future and how their technology will dramatically impact humanity. A lot of the talk on the sidelines and amongst the people that I was interacting with was really around the concerns that the inflation rate that we're seeing, which has come down a lot. I mean, there's no question. I mean, from 9% to 3.5%, 4%, depending on exactly what metric you're using. But I think what people really lose sight of, and this was the conversation that was most interesting to me, is that the math is the math in terms of the rate coming down. But remember that it's a rate of inflation, a rate of increase of prices. Prices are already high, and so we're all in the business of taking advantage of compounding effects to help with investments. Well, the compounding effect of inflation rates remaining above the target of 2% is really quite dramatic. And it's hard to remember, but as recently as probably 2.5, 3 years ago, we were worried about getting inflation back to 2%. That there was really disinflationary pressure. And a lot of that came from for a number of reasons. One has been the globalization of supply chains, arbitrage labor rate costs, and quite frankly, the dramatic boom in production in the oil fields here in our country and making us much less dependent on foreign sources for energy. Because let's face it, as much as we all anxiously await the transformation of our energy system to a more carbon-free system, perhaps, the reality is that fossil fuels, not just for cars, but for literally everything that we do, play a huge role. And so when you have this inflation rate going up so dramatically, it puts tremendous pressure on. And when you start to couple that with the attempts to decouple from some parts of our supply chain, particularly the concerns about China, and as well the fact that we're still short labor. I mean, there's still a lot of job openings, and in particular, in talking to, I spent a little bit of time with a woman from the AFL-CIO, who was actually responsible for technology and labor for them. And there's still tremendous shortages of skilled labor around that, and that is a big part of what is driving some of the labor activity that we're seeing, particularly the strikes against the automakers, the UPS strike, the UPS labor agreements, and I think those are real drivers. And even though there's real potential for the technology to play a role over the long term, in the short term, I think everyone at this conference agreed that despite the tremendous hype we've had over the past 12 months, that things like generative AI and even electronic vehicles are only going to play a modest role in the short term in alleviating any of that pressure.
Interesting. So let's sort of dig down maybe a little bit further and say, because what you just laid out was a little bit scary in terms of people hoping for inflation to come down. So if we assume that we're not going to get it, or the Fed's not going to get it down to that 2% target, what would you see as the most dramatic impacts on the economy and on the markets?
Well, combined with the fact that there's still demands for labor, and frankly, the fact that our economy is still quite strong, the companies that are going to be challenged are those that don't have pricing leverage. In other words, if you can simply pass your prices through to the consumer or the buyer, you can probably maintain your margins, retain your profits. But there are a lot of organizations that ultimately aren't going to be able to do that, because even with the labor agreements that are coming into place, wages still really are struggling to keep up with that with the inflation rate, and are behind the curve because of the spike we had last year and the compounding effect of 3.5-4% inflation on top of that. So it's really a sort of a vicious feedback that you get between costs and the cost of goods driving service and labor costs, and the fact that things like oil permeate, the price of oil permeates almost everything that we do, whether it's transportation, production, any of those things. And so it's hard to see the inflation rate hitting that 2% level in any kind of a reasonable time frame. I think yesterday, as I was flying back in the plane, I was listening to the CNBC conference on delivering alpha, and I think virtually every speaker there was talking about a continuing inflation rate of 3.5% or more. That's going to be tough for the economy to absorb over time.
Totally agree. I think that we may very well reach the point where the Fed talks about the 2% target, but somehow they settle on something higher than that because they're just going to be forced to. Very interesting. And as always, when we do the week in review, my final question is, based on what you have been discussing here today about inflation and potentially interest rates higher for longer, what might investors think about doing with their portfolios in light of all of this?
Well, I think being very cautious around U.S. stocks, given their valuations, particularly the fact that the big seven, so-called, that have been driving a lot of the market, seem quite overvalued at the moment. And that was actually the other talk at this conference is, do we really believe that, for example, NVIDIA has sewed up locked up the market on the so-called high-end chips, GPU chips for doing things like generative AI, and Kevin Scott from Microsoft was the one who, and it was very interesting. He was clearly coached very well on this, but he really alluded to the fact that they believe that there will be a diversification in that effort, and that NVIDIA won't be their only supplier for these kinds of chips, which ultimately may improve the cost and scale. Now certainly it's not like NVIDIA is going out of business, but their valuation may be difficult to sustain. So sustaining the U.S. Market that we've seen this year is probably going to be very challenging. On the bond front, the interesting thing there is that tremendous amount of supply coming on. Yeah. It's likely the long end of the bond market is going to continue to see higher rates. The question will become, at what point will it make sense to lock in some of those higher rates for the long term? Because obviously, if there is a turn and the Fed does decide to cut and rates do come down, then that could be a good place to be locked in. But you've seen the volatility and the rapid increase in rates on the long end just over the past several months, and that seems like in the short term a very risky place to be, and will be very challenged. And as a result, we'll probably challenge the overall bond market. Will be challenged in the same way. Obviously, they tend to work together, and those will go forward. I think there's a lot of interest. There was some discussion around China. I thought it was very interesting. With all the focus on electric vehicles, the reality is that every electric vehicle manufacturer still has tremendous dependencies on China. Yeah. Whether it's for raw materials or actual production of parts. I had a chance when I was out there. One of the things they offered us was an opportunity to drive a Polestar, which is actually Volvo's spin-out electric vehicle. That car, while is made some in Europe, but it's really mostly made from Chinese components. And as a result, has a price point where even though they aren't eligible for the discount, or not the discount, but the tax credits offered by the U.S. government, they discount for that amount anyway to take it. So I think that will be an area to watch. Obviously, there are a lot of geopolitical challenges around emerging markets, but that's still an area, even with the shifting supply chains, that could be very attractive. Certainly, India was a big discussion point. Lot of really active interest there. Europe is probably going to be challenged for a while longer. The strong dollar does help them from an exporting perspective a bit, but they have their own inflationary challenges and a somewhat more stagnant economy, and obviously the geopolitical impacts of the Ukrainian war and things weigh heavily on them. So all that makes cash at 4.5-5% look reasonably attractive and safe for the short term. But in the long term, there's no question that some of the work in technology around the generative AI tools, around the production of electric vehicles, which require a lot less labor and many fewer parts, will have productivity impacts that could make it possible for the kinds of labor rate increases we see here in the United States to be handled through improvements in productivity. It's just not going to happen in the next 6 months.
Right. Okay. So first of all, I'm very jealous that you got to drive the Polestar. How was that?
It was interesting. It was a nice car to drive, no question. As I think everyone has been kind of sampling the market to see what's out there, and it was interesting to do that. It felt a lot like a Volvo, frankly, with electric, with a much more modern and electric drivetrain. So
excellent. All right, great. Bob, thank you. Really great to have you back on the 3 Edge Week in Review. Thank you for your insight and how you connected so many of those the issues around inflation, energy, and labor to technology, which is obviously such a huge portion of everything in the economy. And just by the way, for our listeners, I have the privilege of working with Bob on the 3 Edge Investment Committee, so I already know firsthand how knowledgeable Bob is when it comes to understanding the cause and effect relationships that drive the global market. So I was glad that we were able to hear from him today, and look forward to having Bob back on the 3 Edge Week in Review soon.
Thanks.
So that will do it.
Appreciate it.
Thank you. So that will do it for Bob and me. For this week, next week, Eric Beagleisen, our Director of Investment Research, and I will be presenting our monthly view from the Edge for the month of October. And that's when we provide our most recent outlook for the global capital markets, which is based on our proprietary 3Edge research model. As a reminder, our videos are always available on our 3Edge YouTube channel. If you think that someone you know might benefit from these videos, please feel free to share them. You can simply send them the link to any of our videos or the link to our 3Edge YouTube channel. So until next time, on behalf of Bob and everyone here at 3Edge, thanks for listening.